Hello, everyone. Thank you for joining us. We'll give it a couple of minutes before we kick off. So, hello, everyone, and thank you for joining us today. I see quite a lot of people have signed up. Always shows how much interest we have in the Oman real estate market, especially at this time. It is a tricky period. We find sometimes sort of the time between tides is sort of really the hardest to read when it comes to the market. And it feels like that now. It does feel like we are between sort of two market states at the moment. And as the market shifts, we are seeing differences across the different asset classes. And where do we see that going? So we're going to sort of talk a little bit about that today and go through that, potentially what's happened sort of so far and where we see things going in the medium term. To be honest, I struggle to make head or tail of it sometimes, but thankfully we've got two people with us today who know the market better than anyone else. Matt Wright, who heads strategic consulting in Oman, and sometimes I think he knows the market before it knows itself. Also, we have Swapnil Pillai with us, who joins us from Dubai. He is looking after our regional research. He is the king of data, and he will give us an overview of the regional market, just to give us a wider context before we zoom into the Oman market. Swapnil, I'll start with you if you'd like to give us your regional overview.
Thank you very much, Ihsan, and a very warm welcome to everyone who is joining us this morning. Before we look into the Oman property market in detail, like Ihsan mentioned, we want to have a quick look at the socio-economic trends that have been prevalent across the GCC markets in 2023, and also look at a realistic estimate for 2024 and beyond. Now, when we look at recent estimates from Oxford Economics, it is estimated that the regional economies in 2024 are likely to witness a bit of a slowdown than initially anticipated, but nevertheless, they're still expected to grow more than 2023. Now, as per the recent data that we have got, it is estimated that the regional economies, the GCC economies, on an average, are likely to grow by only 1.4% in 2023. Now, this number is likely to increase to around 2.8% in 2024, which is lower than the initial anticipated number of around 3.8%. So there has been a 100 basis point reduction in the overall economic output for the GCC countries. Now, despite the oil production cuts that were agreed by GCC countries in the OPEC Plus meeting that was held earlier this year, the GCC economies are likely to benefit from higher oil prices, which have averaged around $90 per barrel in 2023. And it is projected that in 2024 and 2025, this number is going to be anywhere between 100 to 105 US dollar per barrel. Now, with higher oil monies, with higher oil prices, it means a higher inflation, and higher inflation means probably a slowdown in economic growth across some of the more advanced economies. It could also indicate probably a delay in interest rate reductions, which we were initially anticipating by the mid of 2024. But nevertheless, it might not have a significant impact on GCC economies, because higher oil revenues in the past have meant that higher income for the local government. It also implies that there will be significantly higher investments by local governments into their individual economies. And the second important point that kind of differentiates the regional markets with some of the other global markets is that the inflation rate in the region has been relatively lower compared to some of the more major advanced economies. It has hovered anywhere between 3 to 5% over the last 2 or 3 years. Now, if you look at the overall economies, Saudi Arabia and UAE are likely to drag or to grow the economies for GCC over the next 2 years. Both these countries have benefited from higher oil prices, but they've also seen significant expansion in their non-oil sectors. The non-oil sectors across both Saudi Arabia and UAE, on an average, have grown by more than 5% in the last 2 years. And the recent PMI data, which indicates the expansion in the non-oil sector, has grown by around 55 in UAE and is currently estimated at around 56.7% in the case of Saudi Arabia. So both these numbers indicate that there is still significant investment that is happening in the non-oil sector. There's still a lot of new orders that are being generated, and there is also a lot of export-related growth that is happening in the non-oil sector across both these countries. And one sector that has been particularly doing well in the non-oil space has been the construction and real estate sector. Now, as per recent estimates from from Meet Projects and also from Oxford Economics, there are close to $1.4 trillion worth of construction and real estate projects that are ongoing across GCC countries, and close to 67%, which is a value of around $955 billion, is concentrated just across the Kingdom of Saudi Arabia. And this number is only likely to grow. Why? Because if you look at companies like Roshan, which is a Saudi-backed government entity and one of the largest real estate developers in the region, they have a target of deploying close to 90 billion US dollars into the Saudi economy over the next 10 years, as it aligns with the Vision 2030 strategy. Now, out of this $90 billion, it has only invested a fraction of that amount across the 2 giga projects that it has ongoing in Riyadh and Jeddah. So there is still significant investment and value unlocking that is likely to happen just by Roshan itself in the next few years, more specifically in 2025. So apart from Roshan, there are other giga projects that are ongoing, and we are anticipating that there will be a lot of new project handovers as well as project launches that will happen across the kingdom. Now, if you leave Saudi Arabia aside, there is still a lot of investment activity and growth happening in other markets as well, more specifically in the case of UAE. If we just give an example, the UAE overall has seen significant new project launches in the last 12 months. But if you look at Dubai in particular, from the start of this year until September 2023, there has been close to 28,000 new residential units that have been launched just in Dubai. Now, compare this to last year, which was around 24,000 units overall. The year before that, it was only 18,000 units overall. And in 2020, this number was only 9,000 units. So you can see that the number of new launches has gone from 9 to 18 to 24 and now to 28. And we might actually hit closer to 30 or beyond that as we progress throughout the year. So there is still a lot of project launches that are happening in UAE, and that has been driven by the spectacular rebound of the residential sector across the UAE. Now, for this presentation, I've just taken the example of Dubai, which has seen significant growth and has broken all previous records in terms of transaction volumes as well as in terms of price. If you look at the bar graphs on the right, you can see that the overall transaction activity in 2022 was closer to around 92,000 units, which was the highest on record. And this year so far, we're already seeing close to 85,000 units. So we are anticipating that this year, the transaction volumes could head closer to 100,000 units, which will be the highest ever on record. Now, just to put things in perspective, if you look at the transaction activity between 2014 and 18, on an average, on an annual basis, we used to witness around 35,000 units being transacted. And this time around, on a quarterly basis, we are witnessing close to 30,000 transactions. So you can contemplate the significant increase in capital flows as well as transaction activity, both from investors and end users, that has driven the residential sector in Dubai. Now, this is just the case of Dubai, but we have seen significant activities both in Abu Dhabi as well, and the relatively quieter emirate of Ras Al Khaimah, which has seen significant new project launches as well as transaction activity on the back of some recent policy level changes. Now, there is a lot that we can talk about the residential market in Dubai and the wider GCC market, but today is not about the Dubai or the UAE market and not the GCC market, but it's about the Oman property market. And to discuss this, I'd like to call upon a very experienced colleague and head of consulting for Oman, Mr. Matthew Wright. Matthew, over to you.
Great, thank you, Swapnil. Yeah, very interesting overview. Obviously, a lot going on. So we'll start with just a quick look at some of the things that have been happening in the sort of wider market. So obviously, with higher oil prices, the Sultanate is now in a much improved fiscal position, over the last 2 years, and that's allowed it to start really investing into some quite large-scale infrastructure and tourism-related projects. So amongst these is, the government's announced that it's awarded a $6.7 billion contract to build the world's largest green hydrogen plant at Duqm. In an interesting move, the Ministry of Transport, Communications and Information Technology has sought advice from international consultants on the first phase of a proposed metro line network for Muscat. And the first phase is proposed to link Sib with Rui, with a spur joining into Muscat International Airport. And then in a reinvigoration of the railway sector, Oman Rail and Etihad Rail established the Oman Etihad Rail Company with the initial purpose of designing, constructing and operating the $3 billion 300-kilometer passenger and freight train link between Sohar and Abu Dhabi. The results of this, when it's completed, will be that travel time for passengers between Sohar and Abu Dhabi will be less than 2 hours. Obviously, freight will be a little bit slower, but it'll enhance the movement of both people and goods between Abu Dhabi and Sohar. The project as a whole is one that we would expect to bring significant economic benefits, particularly to Sohar, as it links Sohar Industrial Port City with Kezad, so both major industrial and logistics hubs. Future phases of the railway network include proposals to extend the network to Muscat, Duqm and Salalah, creating a national rail network. And then we're also seeing the Greater Muscat Structure Plan nearing completion. And the expectations currently are that this will be introduced in 2024. So the aim of the structure plan is to provide a vision and a spatial strategy for the future development of the city. In our view, the introduction of a clear vision and plan for the city by the Ministry of Housing and Urban Planning is a really welcome step forward in sort of guiding the future development of Muscat. And then in terms of tourism, the Ministry of Heritage and Tourism launched, I think, 40 projects across the Sultanate in 2022. And in May 2023, it announced an additional 8 projects, which are shown on this slide, which span across a wide variety of tourism sectors. This is clear reinforcement of the government's aim for tourism as a pillar of growth, and the intention of really improving the tourism sector with a focus on promoting adventure and ecotourism. Both of these sectors, the adventure and ecotourism, really are ones that play strongly into the Sultanate's features and what it can offer. So I think these are all, very welcome progressions. Can we have the next slide, please, Swapnil? So in terms of the population, of Oman saw strong growth up to 2016. And then, as you can see from the chart, it started to slide down from 2017. And then obviously this was exacerbated by the impacts of the COVID pandemic, with the expat population dropping by almost 12% in 2020, and then seeing a more minor adjustment in 2021. But as economic conditions have improved, 2022 has seen a significant rebound in the expatriate population, with it increasing by 20% over the course of the year. And the first half of this year has continued to see good growth, with the expatriate population rising by 6% in the first 6 months of this year in comparison to the end of last year. As a result of the improved economic environment, the expatriate population has actually now grown by 33% from a low point of 1.6 million in the middle of 2021 to 2.2 million in the middle of this year, which is actually the highest that the expatriate population has ever been in the Sultanate. And what we're seeing, the positive impacts of this really notable growth in the expat population over the last 18 months is really starting to become evident, as we'll see later, in the Muscat residential rental market, where there are increasing signs of stability and even some signs of growth in rental values over the last 18 months. Next slide, please, Swapnil. So in terms of the economy, obviously one can see from the chart that 2022 was a remarkable bounce back in terms of economic progress. Earlier this year, the IMF was actually projecting that the economy was going to shrink by 8.5% over the course of the year. But in contrast, the government figures for Q1 were that the economy actually showed some pretty strong growth by 7%. But this is tempered by growth has actually dropped off over the remainder of the year, and we're now pretty much at the same level as last year. As always, Oman's economy, it's perhaps less reliant on oil, but it's still heavily reliant on oil. But encouragingly, that it's projected by the World Bank that oil prices are going to remain at around $85 a barrel up until the end of 2024, which is very encouraging from an economic perspective. And really on the back of this, the IMF projections are for GDP at current prices to see steady growth over the coming years, up to 2028. And to give you an idea as to the impact of this, the projection for 2028 is that GDP will be 48 billion riyals in comparison to 28 billion riyals over the course of 2020. And on the back of this, government revenues have also seen a significant recovery since 2020, with the result, there's been a much more conservative approach fiscally. And the result has been that spending and income are now much more in balance. And we have a much more balanced public sector purse. So overall, the Sultanate's economic position is, as we pointed out last year, is really that the economy is significantly healthier than perhaps one could have predicted, in the middle of 2020. Next slide, please, Swapnil. Okay, so now we'll take a quick look at the office rental market. Overall, the office sector in Muscat remains relatively oversupplied in comparison to demand, but encouragingly, perhaps that supply pipeline seems to be diminishing. So hopefully over time, there'll be a correction in the supply-demand balance. We also note, however, that much of the new supply coming into the market is actually lower grade office space, which offers very poor parking. In terms of uptake, it remains moderate in Muscat, with a strong focus on smaller office spaces. However, encouraging this year in the buildings, the larger scale buildings that we manage, that actually we have seen pretty good uptake of some larger office spaces. Demand remains focused actually on, from companies with an existing presence in Oman, and we aren't seeing that many new entrants coming into the market. And this is a pattern that has been going on for several years. As a result of that moderate demand relative to supply, the result has been that a lot of buildings really actually struggle to achieve occupancy rates in excess of, say, 60 to 70%. For higher grade buildings, which tend to see better demand, car parking as always remains a key issue in attracting and retaining tenants to buildings. But there's a growing focus from tenants in looking at the quality of the building and the amenities that it provides in addition to the car parking. In terms of areas that are becoming of greater interest, our commercial agency is seeing increasing tenant interest in Airport Heights, which has developed reasonably well over recent years. And strong reasons for this are obviously proximity to the airport, great transport connections, and a significant proportion of the Omani workforce actually lives in the sea suburb to the west. So it makes getting to and from work easier for all employees. Despite the ongoing supply-demand imbalance, what we've seen over the last 18 months is much greater stability in terms of rental values. And these for mid-grade to higher end office buildings have really remained pretty stable over the last 18 months. Some of the reason this is a sort of flight to quality. Others are the many landlords are actually now looking and saying that rental values aren't going to come down any further, and there are other options in terms of attracting and retaining tenants, particularly in terms of slightly more extended initial rent-free periods. Achievable rental values, as I said, have remained relatively stable, and there's been little change over the last 12 months. And on a sort of range basis, we would say that realistically achievable values for larger shell and core units are probably 4 to 6.5 riyals per square month across Muscat, with some exceptional buildings achieving slightly higher than this. And for smaller finished units, we're seeing probably 5 to 7.5 riyals per square meter per month. Interesting, similar to other regions in other countries in the region, we've seen a very strong expansion of service facilities over the last decade in relative terms. But despite the increasing supply, demand has really kept up with it. Resulting in, for most of these projects, they're actually achieving very strong uptake and occupancy levels. In addition, rental values for serviced office space have remained stable and on the higher side, and in some cases have actually managed to show an increase over the last few years. Next slide, please, Swapnil. Okay, so now we'll take a quick look at the residential rental market. And the driver, as always, for the rental market is primarily the expatriate population, which has seen, as with the wider population of Sultanate, seen exceptionally strong growth last year. So in 2021, the expatriate population had dropped to 0.75 million from a high of just under 1 million in 2016 and 2017. But 2022 saw the expat population grow by almost 20% to 900,000. So it's nearing all-time highs again. And the result of this has been an increase in demand for rental properties across Muscat over the last 18 months. Next slide, please, Swapnil. So in terms of supply, there's an ongoing introduction of lower grade residential units, particularly apartments, which has resulted in generally an oversupply despite the increase in the expatriate population. The supply of higher grade properties within established localities or larger projects offering a more integrated lifestyle has not seen the same level of expansion and is really seeing a very positive supply and demand balance as demand rises for people to live in places that they feel offer them a sort of more comprehensive lifestyle. In terms of demand, as always, Al Mouj remains probably the most favoured or desirable residential locality in the city due to the quality of the projects, the properties that it offers, the professional management that it provides, and the growing range of retail and food and beverage outlets, and a wide offering of leisure facilities. So people are entranced by the lifestyle that it offers. As a result of strong demand relative to supply, the number of residential units at Al Mouj is now relatively limited. Similarly, Muscat Hills has become more attractive to tenants over recent months with the rebranding of the golf course to La Vie and ongoing improvements to the golf course, allied to the opening of the ABA school in 2022. In the midterm, our view would be the Muscat Hills community is likely to benefit significantly when the 80-key Tivoli Hotel and 2,800 square meters of retail and food and beverage space open to the public in 2026, again providing that more comprehensive integrated lifestyle. In more central areas, we've seen increased demand in Shati Al Khurram, in Madinat Sultan Qaboos, and Khurram, as a result of their central location and the wide range of facilities that they offer. While villas in Azeba and Gubra have also seen increased tenant interest. To a large degree, they're now seen as much more central locations than they were arguably 10 years ago. And also their proximity to the beach is a strong attractant. However, to counter that, there's still a strong cohort of tenants that are really focused on value and looking for low price properties in order to really limit their expenditure. But the scale of demand, although it's increased, hasn't really kept pace with the growth in supply to really absorb that increase. So looking at what everyone's interested in, the rental values. So the chart shows what you're seeing is much greater stability since sort of the end of 2021 in terms of rental values. And we're really seeing stability across all the locations that we monitor. Of particular note, however, are that Al Mouj apartment rental values are strengthened by 15 to 20% over the last 18 months, while in Khurram, we've also seen an increase of around 5 to 15%. Next slide, please, Swapnil. And we're seeing really a very similar pattern in terms of villas, particularly for higher grade villas. Across the board, much greater stability in terms of achievable rental values, while this can be seen, there's been a sustained growth for villa rental values at Al Mouj over the last 18 months. Next slide, please, Swapnil. Okay, so now we'll have a look at what we foresee happening over the next 12 months or so. So in terms of the economy, we would see steady growth, and the IMF obviously is projecting that growth to remain at a reasonably strong level up to 2028. Sustained high oil prices will continue to have a positive effect in driving the economy, while also allowing further investment in other sectors by the government. We would see in terms of the population, the expatriate population in Muscat will continue to grow, perhaps at slightly slower rates than experienced over recent months, but all moving in a positive direction. And then we're also seeing a continued recovery of the tourism and hospitality sectors, but hotel rates suffered significantly over recent years and will generally remain subdued as demand catches up with supply. Next slide, please, Swapnil. So in terms of office space, as we said, there's been an ongoing oversupply of office space over recent years, but encouraging perhaps that there's evidence that the supply of new office space is reducing. And with arguably the potential for a better supply-demand balance over the coming years. Demand from the evidence available is likely to remain moderate and mainly come from companies already in Oman. And as always, there's likely to be an ongoing preference for smaller finished office units. Parking, as always, remains a key issue. We're still reliant on cars to get to and from work, and parking really is key in attracting and retaining tenants. But additional things that tenants, in our experience, really look at are how well is the building managed, what quality, what image does it give, and what amenities does it provide for people who work there. In terms of the landlord perspective, driving good occupancy levels will remain key. and landlords will continue to need to be reasonably flexible in adapting to market conditions to attract and retain tenants. Next slide, please, Swapnil. In terms of the residential rental market, it's perhaps the most positive sector, one could argue. It will continue to be driven by expatriates, but the current evidence is that the expatriate population numbers will continue to grow, resulting in that increase in demand and driving the market forward. So as a result, we'd see that rental values are likely to remain pretty stable at least for mid-range to higher end properties over the coming 12 months, with the prospect of actual rental value increases in higher grade localities, and we'd see rental values at Al Mouj continue a sustained growth over the coming 12 months. As we went through before, tenants are increasingly attracted by properties that provide them with more of a lifestyle rather than being a standalone property. And we also see a continued demand for private villas. Private space is important for people. Private villas and swimming pools are becoming more and more attractive as people look to have that sort of indoor-outdoor balance. In terms of apartments, people very much the two key things for them are the parking that is provided in terms of reserve parking, and what facilities the building provides. This is particularly for the mid-range to higher end apartments. And as always, good property management will remain key. So just to summarize what we've been through as quickly as I can, the broad trends that the Savills would identify are that economic conditions are likely to remain favorable. Oil prices are predicted to remain strong, and that helps to drive the remainder of the economy. We see an ongoing government focus, particularly on infrastructure and tourism projects. And this economic growth is starting to a degree to feed into the real estate sector, with both the residential and the office rental market starting to see increasing signs of stability, with more positivity perhaps in the residential sector, where they really are starting to see some signs of growth in specific locations. So overall, while the rental market conditions will remain to a degree challenging over the next 12 months, overall the picture is reasonably strong, and certainly we would feel that we're in a much better position now than we would have expected if we were projecting from 3 years ago. So that concludes the Oman section. I'll now hand back to Ihsan for questions and answers.
Hi, everyone, and thank you very much for that, Matt. Thank you, Swapnil. I think if we were on LinkedIn, I'd be clicking that insightful button there under that post. We have received a lot of questions from you. Again, obviously, it's a limited forum, so we can't go through all of them. Thankfully, there was actually quite a lot of repeated questions. It was quite clear the areas that were of interest to you. So we tried to focus on these as much as possible. We also tried to pick questions that give us a kind of as wide a range on aspects of the market as much as possible. And I think this will allow us to kind of dive in a little bit deeper into some of that now. So I could start, I think, with you, Swapnil. I think one of the main questions that came, I think everyone's seeing what's happening in Dubai. It's a very hot market. Obviously, people wanted to understand what are the main drivers behind the residential boom in Dubai, and are we seeing new nationalities emerging as sort of significant purchasers in Dubai that are driving this?
Thank you very much for that, Ihsan. I think it's a very, very interesting question, and to be honest, it would be a bit unfair if I pick one or two themes or drivers for the overall market. In all honesty, I think it's been a collective effort by all the Emirates within the country, and also a very systematic planning that the government had put in place for the city or the country overall to achieve what it has achieved over the last 5 or 6 years. But just to bring bit more clarity on what has transpired over the last 3 years, if you see, there has been a lot of commotion and instability both in terms of the political landscape as well as the economic landscape. And during such times, capital usually flows to areas which people perceive to be relatively more stable, relatively more transparent, and more organized. And I think that is what has helped the UAE and Dubai market particularly. If I just talk about the transparency part, the government has now made all the residential transactions available for for individuals to kind of look at. I can probably look at a particular transaction and or a particular residential unit, and I can look at all the transactions that have transpired in that unit over the last so many years. It is the same with regards to the governance as well. There is a lot more clarity as well as participation by the government to regulate the sector and make it more transparent and managed, which then kind of increases investor confidence in the market that they're looking at. And it is not just the residential market; they're also attracted to the Emirate because of all the other sectors that are doing exceptionally well, be it the industrial sector or the office sector, which is then attracting high net worth individuals as well as high caliber professionals to the Emirate, which is then in turn driving the residential sector. And I was having a conversation with our head of research for Singapore last week, and he was telling me a similar situation or a story for Singapore as well. He was saying that whenever there is a bit of instability in the Asia Pacific market, capital usually flows into Singapore, and that is why Singapore has achieved whatever it has achieved over the last few years. And I think Dubai has done phenomenally well to position itself as one of those markets where people are comfortable investing their money into.
Excellent. No, thanks for that, Swapnil. I think it does make sense. I think there was an added question. I'll probably go through that quickly. Matt, if you wanted to add any more to that. I think we were asked whether the same wave that we've seen in Dubai will catch us in Oman here. And I think we need to look at this slightly differently for us in Oman. I think the key drivers, obviously, in terms of supply and demand in Oman are very different. Now, here I'm focusing again on residential ITCs. I will leave the Muscatels and Al Mouj out of this particular answer. We will get to that at the end of the questions. But the main driver for us is demographics. I think you've seen before the graphs that Matt shared. And ultimately, the more policies that we have that bring people into the country, people who not only have a job, but also feel that their job is going to be secure for the next sort of few years, ultimately, it means they will then look to becoming buyers. And also from an investor's point of view, they're looking at that supply being matched with demand coming into the country. And I think that's the main driver, is that not only the supply and demand itself, but how supply and demand is perceived. One of the other points which I think may impact us in Oman is interest rates. I think the UAE, you have a very competitive market when it comes to banks. You have plenty of banks, plenty of products available. I think it's a bit more limited for us here, which is understandable. We're a smaller market. And again, I think if we continue to see sustained interest rates at those high levels, not only will the product itself be more expensive for developers to bring to the market, but also it will be more expensive for end users and potentially investors looking to buy, as the yields, potentially rental yields, won't match. The final one is ultimately the economy itself. And I think as we are linked to oil still to a certain extent, is that oil performance, how that's doing. And ultimately, the more people that we see here, there is an element of a lag. I think Matt mentioned earlier, we're seeing bits of increases in rental rates in certain parts. Now, if that's sustained, and again, it varies slightly, ITCs are quite unique. And to be honest, the academic literature on this is quite complex. So definitely go and look at this yourself if you find it interesting. But the link between the rental market and capital values and how they're linked together with the lag. But generally, we do see a lag between both. We will see the rental market drive things first. You're in the rental market, you begin to find that sales actually I might as well buy rather than rent because things are becoming a little bit more expensive. And also for investors who suddenly find the rental market looking a bit more attractive in terms of returns, in terms of security and reduced vacancy. So I think that's, for us, I would say, keep a close eye on rental rates, keep a close eye on government policies, and that will definitely give us an idea in terms of market performance over the coming period. So just for the second question, Matt, I will come to you on this one, as you, I think, know this sector inside out from a tourism and hospitality. Now, post-pandemic, how do you see that have performed, and where do you see that going?
It's a slightly mixed bag, to be honest with you. By many parameters, we've actually seen a very strong recovery, not a V-shaped one, perhaps in the same way that the UAE saw, but a pretty strong recovery. But there are still some challenges, which will take, I think, a few years to resolve themselves. So in terms of inbound tourism, that's been remarkable, really. So in 2019, there were 3.5 million inbound tourists. In 2020, obviously decimated by COVID. 2022 recovered to 2.7 million. And this year, it's projected to bounce back to 3.5 million. So back at pre-pandemic levels, essentially within less than 2 years of travel restrictions being lifted. In other positive news, so government figures show that hotel guest numbers over the first half of this year for 3 to 5 star hotels reached 943,000 in comparison to just over 870,000 in 2019. So again, these numbers are sort of matching up. The challenges emerge, however, when you start to look at occupancy and revenues. So occupancy was 55% for 3 to 5 star hotels in 2019. But despite increased guest numbers, that's dropped to 47%. And this is almost entirely down to just a greater supply of hotel keys. In terms of revenue, again, guest numbers up. First half of 2019, revenues were 116 million. They aren't far behind now, they're 110 million. But this is, this difference is primarily as a result of lower room rates, which we'll come to in just a second. So in Muscat, really what we've seen is 2 very distinct patterns emerge. And industry figures show that one of the patterns is that the 5-star hotels have arguably not recovered as strongly as 3 and 4 star hotels in terms of occupancy. They've really maintained their average room rates. In comparison, the 3 and 4 star hotels have seen a really strong bounce back in occupancy to pre-COVID or higher than pre-COVID levels. But the room rates are around the average room rates are around 25% less than before the pandemic. And this isn't to do with tourism numbers. This is all to do with the supply-demand balance. And to put that into context, the number of 4-star hotel rooms in Muscat has more than trebled since 2017. And increased competition, low room rates in order to attract guests, and then that places pressure on the 3-star sector. So overall, the fundamentals are really encouraging. More people are coming to the Sultanate, and then Muscat's one of the places that they'll definitely come to. But market conditions are going to remain challenging for a while, particularly for the 3 and 4 star hotel sector. And this is really in Savills really down to this supply-demand imbalance. We have the guests. We've just been building more than demand can keep up with. But in the midterm, one would have to say that the prospects are pretty encouraging as inbound tourism numbers grow. Then that supply-demand imbalance should start to level off.
That's brilliant. That's excellent. Thanks, Matt. It's a pretty potentially positive picture there with numbers, but again, supply keeping things a bit muted there. Swapnil, I think you covered the residential market in detail earlier. The office space market in the UAE in general, in Dubai, has been again quite buoyant. What's driving demand there?
Thank you, Ihsan. So I think, sorry, I think I forgot to answer your previous question completely in terms of the nationalities of buyers as well. So just to bring back that into the discussion. So like I said, I was having a conversation with our colleagues in the Singapore office, and there has been a bit of a crackdown on foreign investments into Singapore, and the government has overnight doubled the stamp duty and registration charges from 35% to closer to 60% for non-nationals and non-residents of Singapore. So with that in mind, we are seeing a bit more investment activity as well as inquiry levels from the Chinese, who have been typically investing in Singapore and in Hong Kong. But because of whatever has been going on in both these economies, there is a bit more optimism and inquiry level for properties here in the UAE, not just in Dubai, but also in Ras Al Khaimah, because of some of the recent announcement in terms of the gaming licensing that is being introduced into the UAE market. So apart from the traditional investor base that we have in Dubai for the residential sector, which includes your Indian nationals, your UK citizens, your Emirati nationals, we are also starting to see a lot more Chinese investments coming into the UAE, which is kind of helping the overall transaction volumes, which we discussed in the previous slides. Now, when talking about the office sector, I think in this part of the world, it is slightly different, and I think you can agree with that, wherein we see a lot more investment activity happening in residential, which then drives demand for other services and sectors. But if you look at most of the other more mature and developed markets like London or Singapore or Hong Kong or New York, for example, they have a very strong office sector, which then becomes a driving force for residential and retail and other support services. And we are starting to see that here in the UAE as well. If you look at Dubai as an example, all the grade A buildings are operating at 95% plus occupancy levels. If you look at DIFC, for example, the core financial CBD of the city, most of the buildings are closer to 100% occupancy levels. ICD Brookfield Place, which was handed over at the peak of the pandemic, has gone from a rental value of less than 300 or closer to 250 to around 400 dirhams per square foot right now because of the lack of space. And what we're also seeing is that because a lot of the wealth management firms as well as hedge funds want to move into the region and they can't open up a space in DIFC, they are now moving their base to Abu Dhabi because of the recent expansion of the ADGM to incorporate Al Reem Island. So that is the kind of volume of inquiry levels that we are seeing. We haven't seen any sort of major reduction or layoff in space that we have seen in other parts of the world. We don't have a significant presence of tech and IT related companies, even though we have most of these companies are focused on the regional markets and they're all very optimistic about their growth. So we haven't seen any reductions from them. We have seen, like I said, a strong influx of financial services companies from the US, from the UK, and also from Asia Pacific. And we're also seeing tech and fintech related companies come into the market. So overall, there are quite a few sectors that are driving demand, which then kind of indicates that the market seems to be a bit more broad-based and balanced rather than being focused on just one sector to drive activity going forward.
That's fantastic. Thanks for that, Swapnil. Actually, that's quite interesting to hear about fintech as well having an impact and seeing the UAE, Dubai in particular as a center for growth. Taking that story to Oman, Matt, I think if we can maybe look at offices, but also maybe retail, maybe perhaps focusing on neighborhood community retail, as well as sort of the office sector as a kind of commercial in general. How do you see that here?
As we went through, I think challenges will remain for the office sector over the coming year. And it is a challenge when you have to build or acquire land to provide good levels of car parking. It obviously increases your development costs relative to what you can achieve in terms of rental values. But the evidence is that if you're proactive and you move with the market and you give tenants as much as you can, what they're looking for, that you can have a successful office building, particularly in terms of occupancy. And there are various larger scale office buildings in Muscat that operate in excess of 90%. There are challenges, but as a landlord, if you move and adapt to those, certainly you can sort of create a defensive position. But over time, hopefully, with things like, the metro line coming in, will that help the movement of people across the city? Will it reduce the reduction on cars to get to and from work? These things can have a big impact, particularly on the office sector in the longer term. So one of the questions we had was, what is the outlook for neighborhood and community retail in Muscat? So first of all, the spread out nature of the city presents challenges for this type of development. Distances long, populations generally aren't that concentrated. But over recent years, we've seen a growing number of successful sort of neighborhood scale retail developments across the city. So in terms of that sort of higher end, the walk at Al Mouj has been, very, very successful ever since opening in terms of rental values, demand, footfall, etc. And it's really become, it's a key focus. It's a key part of Al Mouj and Al Mouj's success. An interesting one, which you're familiar with, is sort of a more organic development, which is in multiple buildings under different ownership, located. These residential apartment buildings, a big cluster located on Sayal Mala Street in Khurram, on the way to one of the PDO entrances. But over time, all the ground floor units have filled up rapidly, and they now provide essentially what a neighborhood retail mall would do in terms of banks, pharmacies, F&B outlets, supermarkets, dry cleaners, etc. So this is something that appears not to have been planned, but has happened organically by retailers looking at what people in that locality, the large number of people there, will actually want. And then we've seen a growing number of smaller scale, but interesting sort of strip or outdoor retail malls across Muscat. And these have all performed well, actually. They're very simple. They're pretty low cost to develop, and they're pretty low cost to manage and operate. But what they, particularly in ground floor units, these are all smaller units. They've been attractive to tenants. They filled up quickly. They've achieved good rental values, and they seem to really appeal to consumer requirements. So obviously, one doesn't want too many of these, but they've certainly worked very well. The interesting thing is really at this level that they're focused in terms of tenants almost entirely on independent outlets rather than the more expensive brands. In terms of the future, well, yeah, as the city evolves, there'll definitely be, I think, further opportunities for developing, particularly neighborhood retail. But as with any development, really the key to it is understanding what you're building and why you're building it. So the absolute key to successful development of this type is really understanding the requirements of both your consumer target market and as a result, your tenant target market, and then building what they need and require at prices that they can afford in order that everyone can be successful.
That's excellent, Matt. I think it is interesting. I think with retail, and again, obviously we've seen a growth and some very successful ones. And I think what is clear, I think, in the market is that if you do your homework and actually know your target audience, you can be very successful. If you end up with a cut and paste and actually just stick something out there and expect it'll achieve the same rental rates, it actually ends up being problematic, and take up is very slow, as we've seen with a number of these. I think the final question, which we'll go through, which has been again repeated many times, which is why we left it last, is the rental values and sales values outlook for both Al Mouj and Muscat Hills. I can understand that a lot of people live there. I'll go through that sort of very quickly. And obviously, a lot of people sort of invest there and not only live there. So I'll just quickly go through that. I would say it's very similar to the answer sort of we gave sort of for the first question with regards to sort of the long-term outlook. But one point to be taken into account here is that even though the supply in Al Mouj, there's a lot of units there, again, Muscat Hills, there's a lot of units, the float, where the number of units that are actually available on the market is actually quite small, comparatively speaking, compared to the rest of the market. So ultimately, I would say two things are much more important here: is the economy and how the economy is performing, and it sort of then drives the rental rates. Because there's a limited number, it is potentially can be a bit more impacted by the conditions of that exact renter and rentee, as it were. If I was desperate to rent something, I'm willing to pay a higher rate because just there isn't many of them around, and the same for Muscat Hills. And the same with sales, where we see the impact of that individual seller and that individual buyer who is very keen on this corner unit in this particular location. So we've seen sometimes a greater variability that makes it difficult to get a feel for that market, purely because the float is smaller. So if you're a seller and just keen to exit, put your money in another investment or something else, then you will potentially accept a certain price at a certain level. At the same time, if you're a buyer and keen on a particular unit, you will pay that higher rate. But I think, Matt, from a kind of a more macro point of view, what are your thoughts on this?
Well, in terms of specifics, the two developments, as per the presentation, Al Mouj has seen a strengthening of rental values. Would expect that to continue. The vacancy level or the number of available properties is limited, and overall, yeah, it's a very positive story in terms of improving. And rental values at Muscat Hills have stabilised, and as we said, with various things happening in terms of the golf course and future development, one would also see very positive signs there in terms of how attractive it is to potential tenants and where rental values might go in the sort of midterm. And you said the provision of the new hotel and the retail and the food and beverage outlets really adds to the development, and makes it so much more attractive for both owner occupiers and for tenants at Muscat Hills. So over the next 12 months, the outlook would be, positive, I think. Nothing, I don't think is going to be spectacular, but certainly positive, which is encouraging. So in terms of resale values, the evidence really from, the resales that we carry out, is there hasn't really been any growth in resales values at Al Mouj over recent years. But coming back to the supply side, now, Al Mouj is very much nearing the end of its development, and there aren't going to be very many new off-plan properties coming onto the market at Al Mouj. While because of its features, its central location, etc., I think it's still going to be a real hub as a magnet for people. So one could argue that in the midterm, that supply-demand balance sort of goes more towards demand in terms of that's higher. You have the sort of seeds of growth in terms of what resale values can realistically be achieved. And then in terms of Muscat Hills, again, limited potential for further development, improvements being made. And again, in the midterm, one can't guarantee it, but certainly the signs, there are signs of encouragement, I would say, in terms of the midterm outlook.
That's very good. Thanks a lot for that, Matt. I think it's a pretty positive story. I think to try and sort of sum up where we're at, I would say stability is the word that sort of comes back again and again, that we're no longer seeing that line going downwards, which is positive. And to be honest, stable is a good state to work towards. If you're a developer, stability and low volatility means you know your exit, at least you know what you need to plan for. As an investor, again, you know roughly where things are at, or potentially where things are at. One of the other things we're seeing is a lot of government entities are keeping a much closer eye on the market these days. They're reacting much more quickly. If things are not working, we are seeing tweaks, we are seeing changes, we are seeing adjustments to make sure they do, which is great, and great to see that sort of proactivity there from a lot of government bodies. One thing which I would say, again, in terms of the 2040 vision, look at the numbers there. I think it's obviously online. If we do see some of those numbers come in, it doesn't have to be the full numbers. Some of those are, again, at sort of certain levels in the short term. If we do begin to see some of those numbers partially fulfilled, we're much more likely to see an upside and a sort of in the short term rather than a downside, which I think is becoming less probable, which is great. So I would say overall stability is a good story for us at the moment, and with kind of higher probability of upside rather than downside. Matt Swapnil, I'd like to thank you very much sort of for joining me today and for going through the things in more detail. I would like to thank our marketing team who put all of this together, and I'd like to thank you for attending this. You will receive the report by email. There will be a lot more detail about many of these aspects in there, so please go through that. And thank you again for joining us today.
Thank you very much.
Thank you.
Thank you.